it should be coming back. Here we go. All right. Now, actually, Joe had a question. Joe says, in my last book, I mentioned option strike pivot points in a couple of times in the trading room. All right. Basically, Joe, I don't have option strike pivot points. What we have is option expiration calendar. I think the last meeting we had mentioned in Thinkorswim, as well as Trade Navigator, as well as TradeStation, all have, get rid of this. Let's get rid of that there. We're going to move this down below, if you can see that, if that got in your way. And we're going to change this chart up, and I'm going to go to, well, let's take a look. This chart right here looks sufficient. We're going to go SPY. All right. So we got the SPY. What you have here are quarterly pivots. These quarterly pivots end on a financial quarter. JP quarterly, right? Financial. This is monthly pivots, but this E stands for option expiration pivots. They're different than the monthly because the monthly is a calendar month and option expiration is the third Friday of the month that expires. Sometimes options will expire, and let's get the right symbol, SPY. Options or indices, kind of like pin is the word, gyrate at expiration towards a specific strike. So, and that when that option series concludes, right? So it's not a calendar month, it's the option expiration. So we wanted to see, maybe was there a coincidence within where the month might mean something, but the quarterly pivots might mean something a little bit better. So quite frankly, option expiration versus monthly, I mean, they're very close. It's 1 week difference, but it was kind of unique study in the day to have the opportunity, the alternative to supply options that tracked the option expiration months, the monthly option expiration. So to me, there's certain markets like Microsoft and you have, of course, Apple, that you might find the option expiration, like the resistance or the support targets, hold a little bit better, giving you a target versus the option expiration. So sometimes the monthly does a little bit better than option expiration. I don't know. This is Danios Corporation, and I was looking for putting up AAPL, a higher Apple. There we go. So looking at Apple, for example, which option expiration, turn it off. Monthly expiration, turn it on. 10 to 1 or the other. One works a little bit better 1 month, and one works a little bit better. And you can, here, we put them both up. And sometimes the support works better and the resistance works better 10 to 1 or the other. Either way, they're very close and very similar. However, for someone who's looking for defined work on a product that is highly optionable in that, and meaning it's has a lot of volume in that option, a lot of trading in that particular option environment, like, for example, Tesla, you may want to look at the option expiration versus the monthlies to get a guide as to what the resistance and support targets is for that time period. That's all that really is. Monthly versus option expiration. Thinkorswim has the same thing. This is just, I'm using Genesis today. It's a lot easier to see on the projection. The so if that was that helped, that should have answered the question. And you can find that on, again, Thinkorswim, Trade Navigator, as I just shared with you, and as well as the TradeStation, the person's indicator on TradeStation. George V asks, what are the steps I take to determine condition of the market? I use that word condition because I don't just look at price. And for condition, there's, pretty much stuff that we look at. What's the condition? Look at the condition. But this chart says it all. When it comes to an individual stock, we wouldn't use McClellan oscillator. McClellan oscillator would be used for something like an index, a stock index. What is the condition of the market? Here's the McClellan indicator oscillator, that is, and this is the S&P 500. So why do I look at the McClellan oscillator and the S&P 500? Well, I really don't. For that, I use a McClellan oscillator modified that's broken down to reflect the information from the S&P 500, and then use Sherman-McClellan's formula and idea behind taking a momentum and a change over time with moving average approach of advanced decline work. And that's what it is. It's pretty involved, but it basically is breadth of the market. So one condition is when it's in regards to stock indices, trading the Dow, the Russell, the Qs, the S&P. For index trading, is the trend up or down? Is it being run by 5 stocks, Microsoft, Apple, Google, Meta now, and Apple? Or is there more stocks going up in association with that said rise in price? The more stocks that go up, the better it is. But if all the stocks go up, it's not that good. So the condition of the health of the market by using breadth analysis can be used in an AD comparative ratio line as well as the McClellan oscillator. Again, it measures the breadth, the advanced decline work of advancers versus decliners in an overall index. So for condition, when I'm looking at a stock indices, I look at the breadth, the condition, the health of how many stocks are going up in relationship to the overall stock index. That's one condition. The next is, what's the state of the market? Is it in a purely excessive volatile range? And comparing what is compare a volatile range to win. For that, I use average true range, ATR. In times of uncertainty or markets declining, markets as we all have experienced and understood maybe by now, hopefully, that when stocks in the stock market goes down, it goes down fast and furious, and it gets ugly, and the width of the ranges expand, and you get an increase over time in the average true range. Average true range goes up. It's an indication that the market is going down. ATR goes down. It's kind of an indication that the market is stabilizing. A stable market with an ATR in a declining mode means that people can more manage risk better, because when you're starting to see, like we were months ago, where we were getting 15, 25, 35 point range moves in the E-mini S&P futures every 5 minutes. I mean, you know, from 2012 to 2019, the 10-day, the average move in the S&P was around 28 points a day. 28. We were getting 28 points every 5 minutes. That makes it very hard for someone to manage their risk, and therefore it keeps people away. And then you've heard the term, oh, we're going to wait to get in the market until the dust settles. Well, what the dust settles means is they're waiting for volatility to contract, and so that scaredness comes out of the market. The scaredness is what's create market sell-offs, right? So people are panicking and they sell, and you get these wild ranges. Someone comes in and buy, and then boom, they come in and they slam the market down, and you get an increase in ATR. 10-day ATR is my favorite time frame. It's about, in a 10-day period, it's what 10 days is about. 10 trading days is half a month. So is the market condition, is it starting to expand in volatility, or is it starting to weaken? And so I do take a look at trends. When I start to see a market going up, like it was back in 2020, and that was when we were starting to get news more of the, what's it called? Pandemic, I guess, COVID-19. We started to see something that was unusual, and we were starting to see a trend develop of the ATR was on a rise. So again, it's when you start to see ATR starting to make higher lows and higher highs, that's a pattern that suggests, man, the next you want to be, take a short position, which I believe we were. And so with that stated, it's also a good indication to know, hey, now's not the time to be a hero and buy dips, not when the ATR is starting to trend up. Then you use other indicators. What's the condition of the market? What's the participation rate? Are there more sellers than buyers? Or when the market goes down, is it on heavy, more cumulative volume patterns. And for that, I like to look at the trend of on balance volume, OBV. Stochastics was my first boss, major boss in the industry, in the market, in the investing world, George Lane. And so I'm more partial to using stochastics even to this day versus any other indicator. So many times you will find on my charts, I can tell you there's a bunch of tools you really won't see on my chart, and Bollinger Bands is one. I'm not saying it's bad. I just don't use it. I find something that's better, which would be in this case Person's pivots and different time frames. I like to look at the condition of the market, so I'm not looking at a whole lot of price-based indicators. And I have one of my own best price-based indicator that gives me buy and sell signals. It's the PPS indicator, which paints arrows on the chart. So with that said, I'm not I don't need a whole lot of moving averages on my chart, like a 5 period or a 10 or a 20 or whatever people are using these days, or Ichimoku cloud charts. I'm not saying it's not valid technical analysis. It's just I don't use it. It's information overload, and I find what I do is a little bit more concise and it's repeatable. In other words, I can teach it, you can use it, and it's something that gives us a good edge in the market. So, George, to your question, what do I gauge market condition? It depends what it is. If it's, again, advanced decline work, and it's a good question, and it's good time to at least introduce people to Trade Navigator, which has been and probably always will be my top, bestest, favorite go-to analytical platform. Why? It was the first one I ever used. It's the first one that Glenn Larson said, "Hey, I like your work, kid. I want to put it on our platform." For the record, Glenn was first. Then it came, we were doing it with Future Source. I don't know if anyone remembers Future Source way back in the day. Woof. Future Source, I think, was bought out by eSignal. I don't know who bought eSignal out. I don't remember. But then Glenn was independent, and Glenn's work, I mean, literally his platform was easy to use. He had all kinds of programmable things in it. It was very competitive to TradeStation, et cetera, et cetera. But with that said, we put a lot of neat things there on Genesis. One of the things that we did back in 2000, and it's debatable, and I can't remember. I think it was 8. It was November. I was at a trade show in Las Vegas. It was either 2008 or it was 2009. Pete Killman was the programmer at the time, just to give you a background story. And I said, I'm trading the S&Ps and the Qs, and we've got the data that breaks down all the stocks in the S&P 500. Can't you guys just build the advanced decline on the SPY, on the Qs, on the Russell, and the Dow relative to me using information on the NYSE, the New York Stock Exchange Composite Index? And that's how we came about creating the breadth analysis. And each one, as you see, ADCSP, that's the advanced decline comparative ratio line on S&Ps, ADC, advanced decline comparative ratio on the NASDAQ, ADCRT, the Russell, Dow Jones, and then ADC is just the advanced decline over looking on the NYSE. The whole purpose of that is there's only 30 stocks in the Dow. There's the Russell 2000. Go figure, there's 2,000 names. They're all small cap. None of them, for the most part, are dividend yielding stocks. That's why they're considered growth stocks. They haven't grown. They haven't matured to become a full-fledged company that pays dividends. Then there's the NASDAQ 100 and then the S&P 500. They all have different weights of different sectors, such as financials, utilities on the S&P 500, along with technology, versus the Dow Jones Industrial Average. Every stock in the Dow is in the S&P 500, for the record. And I just think that sometimes you get one index that might outperform relative to the other. And what helps me to say, is there good breadth or good, I guess that's the secret, is there good participation, is by looking at the breadth of the market. So if it, to me, and I say this in the live trading room all the time, my bestest buddy of any indicator studying the indices will be the advanced decline. Not volume would come second, price-based indicators would come third, and I would use my indicator, and then fourth would be again, person's pivots, and I tend to one or the other. If the layout of person's pivots is highlighting a neutral bullish stance, blue above gold, I would say, gee, the market's bullish. So, such as the market, if it's in a bullish phase, the weekly pivots would illustrate if the market's truly bullish, markets trade north of the pivot, meaning above the blue line. So I think George's question is something I think everyone in today's meeting could take something away from. If I see a buy signal in right here, which is that triangle, and I would say, well, what is the health of the market and the buy signal? First, I would say, gee, it closed above the weekly pivot. A daily close greater than weekly pivot's a good thing. It's not a bad thing. It's a good thing. A daily close greater than weekly pivot is a good thing. If there's increase in volume associated, and I'll just line this up. So here's a market that generated a PPS buy, market close greater than pivot. The advanced decline is moving in which direction? Higher, right? And it came on good volume. So what do I mean by good volume? Well, volume trend at this price on that close on that day, here's the volume reading. It's making a sequence or a series of higher highs, higher lows. It shows there's some accumulation in the market here. Now, I don't know if the next day the market's going to go up to hell in a handbasket or if it's going to fail 3 days later. So that's why we take a look at the market. Market had a breakout from that point. It hit weekly resistance. The market pulls back. The breadth of the index is still neutral positive, meaning it didn't take out a prior swing low. The volume is still pretty decent. And then what happened? Market had a little bit of a pullback. It went back up. Advanced decline is still strong. And then as the market rises, advanced decline is making a series, a consecutive series. The advanced decline, looking at, again, George wanted to know what I'd look at for condition. The advanced decline is making each subsequent low in the market. The advanced decline itself is holding up, making higher lows. While the on-balance volume did not hold up, it made a newer low from the preceding point low. In other words, this is the preceding point low, and this is now a new low. The breadth of the market was better than the prior swing low, better than, greater than, higher, above. Volume was below, negative, not positive. So when I tell you that the condition of the market, what is the participation rate in the index? More stocks, while the stock market went down, not as many stocks went down too, making a new low in the AD line, the advanced decline line. Had the advanced decline made a newer low, I would be very nervous being a long holder in the market. The fact that it held pivot and it's still in a daily buy, the market went back up, would tell me, at the very least, I would not want to be short the market when you have a PPS buy, pivots are holding, and the condition of the market in regards to looking at a stock index by the advanced decline, the comp ratio line was positive, had a positive reading. So, George, those are, for me, those are the ones that I look at for determining condition of the market. And if you read my newsletter, probably, let's take a look. Well, we don't want to change that, but if you took a look at my newsletter on the website, or if anyone reads the newsletter, you'll notice that this chart, exactly what you see here, is whether it's completely legible or not, it has several important areas of the market. What's the seasonal trend of the market, up or down this time of year? If it's down typically, and my volume readings aren't great, and we're at resistance, and the breadth of the market doesn't look promising, I'm more than likely am not willing to go out on a limb and buy high correlated stocks to the Qs or technology kind of names, because the condition and the seasonality of the trend is not in our favor. Now, if you were in the live trading room today, or last week, or any week for that matter, and I'm looking at trades, I'm trying to prognosticate, especially around earnings. So one was Starbucks today. My work was neutral on not Starbucks. What was it? The one that PayPal. My work was a little neutral on PayPal. I didn't have a good read, and they were expecting, I think, like an $8 move or something on PayPal. I think that's what I posted in the live trading room today. Correct me if I'm wrong. And I said, my work, because it's neutral, it might go up or down by $8 or something like that, which is a 10% move. I would be more willing to do an iron condor, selling upside calls, spreads, and selling downside put spreads. And I would do it outside of that $8 range. And so when I looked at the options, the only thing I would be able to collect on a $5 wide strike on PayPal, I think it was the 95 calls, selling the 95 strike calls and buying the 100s, and then selling, I think, the 75 strike puts and the 70 puts against it. I think that 5 wide was going to collect like 40 or 50 cents. Now, I just didn't. I think those are my exact comments that, and I'll say it today, I'll say it tomorrow, I'll say it next year. Collecting premium of 40 or 50 cents when my risk is maximum 5 minus what I collect. So in this case, if you collect 50 cents and you have a 5 wide strike, your maximum risk is 450 to collect the lousy 50 cents. I think I could do better and try to pick up 50 cents any other time. The implied volatility was pretty strong. I didn't have a directional bias in the market, and I wasn't just going to, get the rule book out that says sell implied volatility when it's at extreme levels. And so for that reason, I didn't have a directional play, for example, in PayPal. And the fact is, I even mentioned I actually use Venmo, by the way. So I kind of didn't have a feel for this earnings, and the earnings, by the way, came out strong. So the reaction so far is positive. We'll see how it opens tomorrow. A reaction in the post market and how the market opens the next day is a different story. And today we saw, by the way, in that with that theme of thinking, if anyone saw Illinois Toolworks, which is my number one go-to economic global economy stock, if you want to see how the real global economy is doing, follow Illinois Toolwork. If you don't know what they do, go Google Illinois Toolwork product supplies and see everything that's under their wing. And you'd be like, Rain-X is one of their subsidiary products, by the way. So when you look at Illinois Toolworks and you look at their earnings, which was, I thought, pretty decent, but the market opened lower, traded higher. It was all over the board today for an industrial stock that most people don't know who in the hell it is. ITW is the stock symbol. So there was a lot of volatility in some of the global names of industrial, chemical, and materials, let's call it, right? With that said, it's not important how something opens. It's important how something closes. And that's why we look at not just the initial price reaction. We don't just look at the overall price action. We look at thanks to George getting me to answer his question, we look at the market condition as well as looking at the market condition over time. After the first hour, is it a real move or a sustainable move? Is there strong volume? Is there weak volume? So volume is another one that I look at. And so when I'm trading stock indices, obviously old points of interest are important to me. Green means you probably would surmise, if you saw this, you'll see this in the newsletter week in and week out. Seasonal trend, not warm and friendly this time of year, by the way, as we hit into August through October, the worst time frame for the market. That's probably why I'm not hot and heavy buying the breakout here versus the last couple weeks. We weren't bearish in the hole either. The advanced decline was steady Eddie, meaning we weren't breaking down with new, great, substantial newer lows. There was no real tremendous volume in the market. It was just steady. So when I say, what is the condition of the market? Yeah, sure, price trend is down, but the advanced decline over a week basis is stabilizing. The advanced decline week over week is stabilizing. That's a good way of defining it. There is no real concernable volume on the major sell-off, and you're at massive support. What kind of support? Well, you'll be surprised to know that I actually use my own work. Monthly pivot support, right? So monthly time frame support. And then to answer another question, we could go with option expiration, which in this case, monthly support is what on the at least with the indices. And as we get near the end of a quarter, by the way, we use quarterly pivot support. So quarterly pivot support doesn't work all the time, but it's very effective in identifying the condition of a market, such as if the market's truly bullish, it should trade north of pivot. If the market's truly bearish, it'll trade south of the pivot. I know I've already said that before. A monthly or weekly close greater than a quarterly pivot ain't bearish. So I think in this case, we have, at least looking at a weekly chart in the SPY, I could just say, using my indicators, I can give you a read right now. We had a weekly PPS buy, a high closed doji pattern. And if you look at the 1-to-1 risk-reward ratio, we almost hit that objective, if not completely. We have resistance up here in the market, by the way, right against the last conditional change. That's around 416 and change, more or less. The high was based on June 10th at 416.61. There it is, the exact high. So the market may have gotten a little ahead of itself. The advanced decline was pretty rich. There's no volume in this move. The seasonal trend does not work out so well in this time period. So this is not a time for me to get very aggressive in buying underlying stock indices at this point, especially in the spider, right? So to look at maybe perhaps one that in the trade room, I said, listen, this one might have a little bit more legs to it. Volume was a lot better. It's in the Russell, by the way, which is weird. The Russell had a stronger reading of the advanced decline, a stronger reading relative to the S&Ps and the Qs of its volume trend, which is ironic. So for that, if we take one look at, I'll add one other thing, and that is, what is the overall trend? I can't determine the future, but what I can do is use seasonals to say, what has the typical trend been in the last, say, I don't know, 20 years, 30 years? What is the typical trend in the summertime? In August, it typically goes down the first week and then goes up into September. And that's kind of counterintuitive to what the other indices are doing, right? The other indices actually go down into October. This one has kind of a stable upside, the Russell. So the Russell might have a little bit more upside. So if anyone says, gee, look at the Russell, it didn't go down as much as another index, there might be better opportunities in looking at Russell based on the seasonal trend, and then say, gee, is there more volume in the Russell? Does anyone else believe that? Because the last thing you want to be is like a follower of some analyst like John Person, who says, gee, the seasonal tendency is to go up after the first week in the Russell. And the only other person who believes that is, I don't know, one other guy. We want to see if the rest of the trading community believes that, and which would be reflected in an uptick and an increase in the on-balance volume trend. Is price going up with an association of participation and improvement in volume? So, George, breadth when trading the indices is more stocks going up, and volume participation, is it being driven by strong volume? That would equal that there's an odds of that the trend could see more sustainability and see more price gains. If you have an increase in the breadth and an increase in volume, you have a sustainability of an uptrend. And that's probably the best that I could define, and hopefully gave you the answer you were looking for, which was a pretty good question. So for that, let's take a look-see here at what else we got going for us. Gerald from Roswell, Georgia. Roswell, New Mexico, I've heard of. Roswell, Georgia is near Atlanta, near Marietta, I believe. There's a wonderful golf course, if I'm right, Gerald. If I'm not mistaken, I forgot the name of it, but Georgia's got a bunch of good golf courses. Augusta's one, but that's a different story. Trev. Trev is asking, John, I was wondering on how to put the crack spread on chart and TradeStation or Thinkorswim. You know, Trev, I was wondering the same thing myself. I think I used to know how to, it's a ratio spread, I think a long time ago. like in an era long gone when dragons blew smoke out of their mouths and fire. Uh, in the time when dragons were flying around the air, I had Stanley Dash, who was the director of education at TradeStation, come to my office when we did a mentoring. And I think we tried to do it, and TradeStation didn't allow for the crack spread to be programmed. I thought we tried to do that with TradeStation. And I'm not going to give you the answer you're looking for in a PUG meeting because day in and day out, and even in the newsletter, it's funny you asked that question. I use Trade Navigator, and one of the things is because they were commodity based, and I have a page here. It says you saw it. It's titled RS Analysis and Spread Charts, right? So if you take a look at my page when it stops circulating, it says RS Analysis and Spreads. And this page is created, something I created. I've got the knob spread, which is notes over bonds, the difference between 10-year notes, 30-year bonds, and the Dow Jones Industrial Average down here. And by the way, just to let you know that stocks and bonds are not always an opposite trend. You'll notice that the Dow went up, the bonds went up, and the notes went up. It's just the bonds outperformed relative to the notes. And this right here is a spread chart, which illustrates that. When bonds are more interest rate sensitive than notes, the long end of the yield curve is more sensitive to price and again, interest rate movements. So with the Fed raising rates, the market kind of was is suggesting with the spread. So if you're just looking at the notes and go, oh, it's a minor rally. But if you look at this, you'd say, hey, this looks like a more impressive rally because the spread ratio difference between notes and bonds relative to notes really super duper outperformed. So the moral of the story is sometimes I like your questioning, how do I get it? Because spread charts actually do, and spread trading itself, there's an old phrase of mine that I share. Bulls make money, bears make money, but sometimes spread traders take all the money home. So we do in the live trading room, you guys have seen us do like the March, the Novi March bean spread, the August, April live cattle spread. Those worked out very nicely. And we do from time to time more spreads. And in looking at the undertone of the market, sometimes spread analysis, aka pairs trading, will give us that better insights. And one of the more famous spread trades that Trev is asking me to create for him in Thinkorswim or TradeStation, which I would have to really sit down and remember and dig deep in my mind because I really don't know the sequence, and I don't know if it's possible because there's a division. If you go to just this particular chart here, this is a chart data, and you notice you can click on either a symbol or a spread, and Genesis already has custom pre-programmed crack and crush spread in the market for us. What does this mean? The crush spread is the difference between soybean meal, soybean oil relative to soybeans themselves. So grain traders and farmers will look at, just like the crack spread for demand for soybeans, they'll look at the ratio or the spread and the difference between meal and bean oil. And so if that's the crush spread, so traders would look at the crush spread in that case. Genesis pre-programs this already for us in a ratio well provided. So bottom line is I'm really not sure how to do it on TradeStation, or I don't think it can be done on TradeStation because it requires a multiplier. And Thinkorswim, it has something to do with an asterisk next to the symbol. I think it can be done in TradeStation. I just don't remember off the top of my head. Okay, and maybe in the live trading room, Trev, we can work on that. But what does a crack spread do? If the spread widens, it shows there's better performance in the byproducts, reformulated blend gasoline combined with heating oil, which is a derivative product of, let's say, aka diesel fuel. Yes, we don't use heating oil in the summer for the most part, but we do use diesel fuel. Heating oil is a very similar product to diesel. And so as a gauge of demand for the undertone of the products, when the crack spread narrows, meaning gets less positive, narrow meaning it goes down, and that's what it's been doing over the last couple weeks, it's not a good thing to be long exposed to crude oil or energy stocks. So when a crack spread widens and starts to get less negative and builds a base of positivity, you are more apt to want to be exposed to the long side of refiners, XOP, and energy stocks. When the crack spread starts to peak out and narrow, el no bueno. And so right now we have a weakening condition, which is another thing that we bring to everyone's attention via our advisory service, all right, and the newsletter. So in fact, this week's newsletter illustrated this exact same chart. So thank you for, I wish I had a better answer for you. Yes, it's valid analysis. Yes, I use the analysis. I use other analysis, spread charts between materials and utilities. You can see a lot of my interest in charts that I look at. And so for myself, whether it's soybeans, I don't remember, it was probably a couple, when was it that I pull out in the newsletter? I think it was this particular week right here to do a ratio back spread in soybeans. I mean, look at the seasonality on soybeans. I mean, I didn't think it would happen the very next week. It was just absolutely bizarre. The timing is right. The volume trend was weakening on a new high. It just, seasonally speaking, was like el no good, very negative. And by the way, this is a spread, kind of like a spread ratio chart, kind of like the PMC. It's a relative strength chart of the S&Ps. It's not an indicator you would use with soybeans, for example. So again, for what are the conditions, back to George's question, would I use relative strength on soybeans? No, but I would use relative strength on MCHP, microchip, for example, and say microchip has a stock which was coming out with earnings, and I think they had a pretty good earnings report. I don't think the market's really reacted much to it. The seasonal trend is up. The strength in the volume is off the charts relative to the price. And what I mean by that is the on-balance volume, what is the condition of this stock? Well, the on-balance volume suggests there was more volume participation than when prices were at this peak. So at 73, the stock's at 69. So it may, if volume is true that it precedes price, this stock is being led by stronger volume in a very strong seasonal time frame when the relative strength is out, its own stock percentage move is outperforming relative to the S&P 500. And how do we know that? Because the RS line, which is red, is moving up. And how do we know it's moving up? It's hard to see. Well, because it's above the blue moving average line. So, and it made a newer high, another relative strength outperformance. So it's increasing in its relative strength. That's an indicator of condition in of itself. We also have seasonality is on our side. I'm not saying it's going to work every time or every year, and this year could be a muted move. But it allows me to say, listen, if earnings do come in and they're positive, at least we could ride the seasonal trend of this a little bit more rather than playing a I don't know trade, right? Well, so let's just sell some implied volatility and not worry about it versus, gee, what if it's a decent report and the seasonality trend was up? The condition of the market was bullish and is bullish. And there's no doubt that that you can say that because here we are with quarterly pivots. It's already at its resistance. It's already pulled right through option expiration. Monthly pivots got a little bit more to go to the upside. And bottom line, this stock has really improved on volume, especially over time. So anyway, those are the kind of the things that I break down in using our analysis. So I hope that was something that, again, the PMC indicator is found on TradeStation and Thinkorswim. For 10 to 1 or the other, why isn't it on Genesis? It would require the guys at Genesis and John Person to find some free time together And just one more thing to do together in free time, and add and spend time programming stuff. And time is, well, getting short in life. So anyway, that's the moral of the story. It hasn't been added. Maybe one day. I'm not saying it won't be, and there's no other reason other than time. Anyway, so let's see. John, are we supposed to be seeing a black screen at 4:49? I hope you've been seeing a regular screen the whole time. TCB Trader says he lost sound, and he says no, it's back again. Was everyone seeing the screen? Hopefully. Yes. Oh, awesome. Good. 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 Thank you. Thank you. Thank you. Okay. So, because man, that would be nothing worse than be talking and describing the indicators and not having them on the screen. That would be no bueno. That's and that goes in the old, that phrase, "sharp as a knife." There's in the world of the knife drawer, you got the butter knife way on the left. I mean, you can give that to a newborn baby; they ain't gonna cut themselves. The butter knife, the real circular end knife, right? And then you got, not that I would give it to a newborn baby. I'm just saying it won't cut anything. And then you got the ninja, the Ginsu knife, right? The knife of all knives. It cuts a nail, chops an apple, cuts down a tree. It's the sharpest knife in the world. I never proclaimed to be the Ginsu knife, but I know, as sure as I'm sitting here, I am not the butter knife. But projecting a PUG meeting and describing indicators and having a blank screen, that would go under the butter knife category, I'm pretty sure. Anyway, MACD, oh my God. Is it MACD like Gerald Appel's moving average convergence divergence? I can't believe it. Love the doji indicator. Would like to know how you use it. Different time frames. I look at the high and low close doji as not an indicator as much as it's an actual trade system, and it tells you when to get in, where to place your stop, what your holding period is within 8 to 10 bars, and your 1-to-1 risk ratio, 1-to-1 risk reward ratio. One of the markets that we generated in the time frames I use monthly, which doesn't happen a lot. You can imagine why. It takes a whole month for something to happen, and it's after a downtrend. Monthly is one. In fact, we do have one really weird anomaly, and let's take a look at it together. Bang, monthly bonds, bond prices. The monthly chart on bonds formed a high close doji. Bonds, a high close doji. Now that is weird in itself, considering the fact the seasonal trend does tend to go up now, right? And a 1-to-1 risk reward ratio, you could clearly see that if you have a 1-to-1 risk reward ratio, how I use it on a daily basis, a 5-minute basis, 1-to-1, it's suggesting a potential move. It would take 8 to 10 bars, which, by the way, what is the high of this bar? The high is 159.13. 159.13. What a coincidence that the high of this red bar is the price projection move of the 1-to-1 risk reward ratio. Your stops go underneath the low of the doji. You enter in either on the close or the next session's open. And in this case, since the monthly high close doji was such a wide range move, I would probably suggest to maybe look for a little bit of a pullback. But you're until proven wrong, I would not be selling bonds right now, because both a pattern of a high close doji exists, seasonal trends to your advantage, and that's the strategy, not just an indicator. It has to be after a downtrend, not an uptrend. So this would be a doji and a close greater than a doji. That's after an uptrend. That's not a high close doji. 1, 2, 3. By the way, this never came out to be a low close doji, so we wouldn't use the 1-to-1 risk reward ratio setup. So the high and the low close doji are more of an actual trading system strategy. That's pretty fantastic to use still to this day. So monthly, at the end of every month, that's why in the live trading room I do scans before the end of the month. I say, boom, here's what we're changing. Guard is monthly. Weekly, we do it for the end of the week, to the point where I think this other platform here, and I would go and say, many are familiar with HGSI as well. HGSI, we put our work on HGSI because the scans there are fantastic. The way that product breaks down the sectors and industry groups and subsectors. And we added the high and the low close doji weekly scans, which many of you would probably note I share with that as well. So almost everything that my name is on and the products that I use, I actually use. So HGSI, I actually use. Genesis, I use. TradeStation, Thinkorswim. Those are the four I don't really need a lot. If someone said, hey, John, what about XYZ company and this company and that company? I'd be like, well, I'd have to learn how to use it. Then we have to go and take time to program it. And I mean, everything we need is on these markets. So granted, one has something that the other doesn't have to a degree. So for example, Genesis doesn't have the PMC. Everyone else does. So maybe we need to get together with Glenn one day and put in the PMC, the relative strength indicator. But other than that, there was another one here, by the way, which was a company called Meta, Facebook. And Facebook had a chance. Meta, not Facebook. Meta had a chance today. Here's a doji. It needed to close greater than the high of 161.51 today. It never happened. Facebook has a seasonal upside. Volumes El No Bueno. And this is one that had a shot at a high close doji. And unfortunately today it never materialized. So whether it's daily basis, 5-minute, 15-minute basis, we do utilize the high and the low close doji. When I will not use it is if, for example, it's after a downtrend and you get a low close doji on a downtrend. That's not a low close doji. After a downtrend, you get a high close doji. You would say, gee, that's a high probability. And so we didn't get it in Facebook today, by the way, or Meta for that matter. All right, I think we've hopefully made it worth your while of what indicators do we use, why are they important, and answered some decent, I think they were pretty, in my humble opinion, decent questions last I checked. And Gerald says it would be great to have, oh man, TC2000. I can't, yes, they do. Gerald, not saying their scanners aren't good. TC, was that the Warden brothers? Am I right? Warden, was that the Warden brothers? Are they still alive? One of them passed, I thought, right? I'm getting too old. I shouldn't even know this stuff. Oh my goodness. I thought one of them passed. I can't remember. But yes, you're right. I just never got around to TC 2000. But anyway, all I can say is that we have indicators and tools. And one thing that I could just tell everybody, no one single indicator is perfect. Absolutely. No one single indicator is perfect. But I think that combining, rather than using a whole bunch of stuff, and someone's going to ask me, or someone should ask me, what is this? These blue lines right here, these crosshairs, this blue line right there. That's the 11-week cycle. I wrote about this in Futures Magazine in 2002 on the E-mini S&Ps. It's something about the 11-week cycle. And the next anniversary due date, it's on the week of August 26. So seasonal trends, it's ironic you have a seasonal uptick in the market. Now, ES has nothing to do with the McClellan Oscillator on the NYSE on a weekly basis, but does everyone see where the McClellan Oscillator already is and the market barely rallied? It's overbought on a weekly basis. Now, it could stay overbought till hell freezes over, until you get bored or tired. But the odds are, in a seasonally weak period of time, in an overbought higher time frame breadth indicator, I have a cycle. The last thing George, I would say that I look at is cycles and pivots, and they're kind of similar in structure, their time and its price, right? It's a lot different, but it's more time based. The 11-week cycle, every 50, 11 is not a Fibonacci series number. In other words, if you take 1 and 1, add it together, you get 2. 2 and 1, you get 3. 3 and 2, you get 5. 5 and 3, you get 8. 8, and all of a sudden 3, you get 11. So 11 is your, excuse me, did I do that right? So 11-week cycle. And if you go out, you go 55 and go to a daily chart. So the daily analysis and the weekly analysis, 55 trading days doesn't really mean a lot, but it's 11 weeks. And it is a 1 week shy of 3 months. And there's something about it that it doesn't work all the time, once again, and that's my whole point. But it's just one more function that I look at. I don't put my whole life savings on one indicator, but it's a combination of a bunch. And then stops and risk management is very vital because nothing's 100%. But I will act on a trade if my kind of like stars are in order. So if we get an 11-week cycle due date, which dictates the markets come or near highs that we could see a correction. If we're entering a seasonally weak period of time, if we have other indicators, not a price-based indicator, but a condition indicator like McClellan Oscillator is in major overbought territory. And then for the next 3.5 weeks, we gyrate back and forth, and the McClellan Oscillator for the next 3 or 4 weeks starts to show some weakening trends. I bet you it's going to be a real rough September, October for the market, real rough. So my guess is the annual low in? Probably not. The annual low. Is that annual low in? I don't, I can't tell you that it can't get retested. I could tell you that if there is going to be a retest of the lows, it's going to happen sometime between here and October ahead of the midterm elections, for sure. And that would be my 2 cents. So I think this year we are obviously the Fed is very data dependent, right? Number one. Number two, the indicators that we have are a reflection of human nature and human participation in the market. If the advanced decline starts to show relative weakness on rallies, if on rallies there's no volume supporting the move, baby, that's not a really strong market condition, and I'll be looking to. And then again, we get a PPS sell signal on an 11-week anniversary cycle high due date. You can bet your bottom dollar I'll be buying put options for a downside move. And those are the indicators that I use, and that's how I put together both my research in a written report every single week, and that's where we go for that information. It's these indicators that have served me well through decades. So again, I don't use multiple price-based indicators. I don't. Maybe stochastics is one. I don't use moving average convergence. I don't use 20, 50, 100 period moving averages, the 200-day moving average, for Christ's sakes. Those are just things that are irrelevant, and I think we found something a little bit better. And then when you apply pivot analysis, I mean, for gosh sakes, if the market does get up near pivot resistance and fails at resistance, I know for sure I'm not going to be looking to buy at resistance. And if we start to close back and get a sell signal and the market closes below a pivot level, my Lord, it's generally not a good sign. If the monthly pivots dictate at the end of a time period, next time period is going to be bearish with giving you a lower projected low and a lower projected high, meaning lower red, lower green. I mean, why are you looking at, buying every dip? It's if the market's truly bullish, like over on the left side, you're going to get monthly readings of higher highs and higher lows, and the condition of the market is going to be supportive for an upside move. If the market's truly bullish, man, the pivot, the blue line, should act as support. Remember that rule. At the very least, if the market's truly bullish, blue line should act as support. When blue line starts acting as resistance, there's a problem or a change coming. And that's where you start to see, again, a change. 1 month it didn't work right here. It changed on us. It went higher first. Support. All of a sudden it started to act a little goofy in here. Then the market started to look what? Closing below the pivot support again. And then you're back on track where everything's kind of working in sync. This is using the monthly time frame of monthly pivots. That's a very important picture of person's pivots. How effective and efficient are they? They work really wonderfully 75% of the time. And that, my friends, gives me the odds of saying, listen, at the end of the month, what is next month's market condition? This month is supposed to be a neutral bullish month. We have a higher green and a higher resistance for the month of August. And after that, we'll take it one step at a time. And until we actually get through the quarterly pivot resistance, this market's going to struggle, bottom line. So bottom barrel analysis is, I think, George coming in and saying, John, what do you use and what are your conditions? There it is. That's the nuts and bolts of John Person. But, you know, we do these seminars, and just as a personal announcement, if you guys are interested, we are finally, I guess, after COVID, we're doing another seminar. We haven't done one in a live seminar in obviously years. So we are hosting one down here in Florida. And for the record, go to the website. You can check out the seminar. It's going to be, I think we've already got a really strong class already. A lot of signups, so it's exciting. A lot of people saying, I want a little bit more of what John can offer. And sitting in person is pretty cool. And also sitting around with other traders and seeing how they've maybe tweaked or used other things with my work. And that's kind of cool. We're also putting together something because trading is exciting and it's great when you're right, especially. When you're wrong, it's like, okay, did I follow my game plan? I did. It just went wrong. Okay, doesn't work all the time. That's why it reaffirms stops are not for sissies. But because trading isn't always about just trading, we're going to try and do something exciting. Years ago, we put together a group of guys on my boat. We went out fishing, caught some mahi. That would be mahi, fresh mahi. Of course, everyone traveled, so no one could take it with them. So I got to keep it. Thank you, guys. This year, I think we could either do that again or there was a vote for a golf outing. So I think a golf outing sounds exciting at the very least. So, you know, we're going to do something with an extracurricular activity surrounding our seminar for those that maybe before or after the seminar event. And that's always good for bonding and getting together with people as well. I want to say thank you all for attending today. That does conclude the time. And with that said, if you're interested in more information on the seminar, just visit the website, personsplanet.com, and we'll get some information out to you. Thank you all very much. With that, J.A., you behave. George, thank you very much for enticing me to explain the indicators. I hope everyone benefited from that because, quite frankly, it's what I see kind of can work more times than not. Thank you, everyone. Have a great rest of your evening. And I'll see everyone, for the rest of you, in the live trading room tomorrow. Thank you.